So today folks, we're stripping it right back and going back to basics. I've even decided to have a change of scenery and go al desco again. And in fact, if you watch my videos regularly, I'd be interested to know, do you prefer the blue screen or do you prefer the desk? Let me know below. On one of my recent videos, I had a suggestion from somebody saying it would be really useful if I did a video on how to invest different amounts of money. And I thought, what a great idea. So, Dubai MC, this one's for you. So the purpose of this video is to tell you how to get the maximum amount of growth and the maximum tax advantage no matter what your starting point is. Now I want this to be a broad template, which means I'm not going to go into every single bit of detail. What I'm going to focus on is the main investment wrappers that are available to you and when you should think about incorporating them. Sometimes people just put too much complexity in the way and it stops them from wanting to get started, or so confused they just don't know where to start. So we'll start with the main housekeeping basics and then we'll move on to when to start blending different investment vehicles into your portfolio, whether you're starting with a little or you're starting with a lot. As always, I'll put some timestamps below because you might want to skip forward to a section that's most relevant to yourself, so check those out in the description. And if you're here for the first time, I'm Chris. I'm a financial planner who specialises in helping people gain financial independence early, tax efficiently. And I create videos every week to share my knowledge of investing strategy and tax planning to help you. So if you like the sound of that, then hit that like button, hit subscribe, turn on those notifications. It's all completely tax-free. Let's do this. Now before you start throwing money into the market, there's a couple of very important things that you need to do first. If you're a little more advanced, feel free to skip ahead. But number one is ensuring that you get rid of any bad debt. Now there's a difference between debt that's good and debt that's bad. And that's probably a topic to cover in another video. But essentially, bad debt is anything that you're paying high interest on that isn't being used to purchase an asset of value. An example of that would be credit card debt. If you've got leftover credit card balances that aren't on a 0% balance transfer rate, you need to be getting rid of those before even thinking about investing elsewhere. Credit card interest rates are invariably very high, at least in the high teens usually, and saving that amount of interest is the same as making it, so that will give you the best return on your money initially. The second thing is making sure you've got a reasonable amount of emergency cash just in a savings account. You don't want to have every penny invested because investments are for the long term and you don't want to be dipping into them in the short term. That could do you more harm than good. There's no specific amount of emergency cash that you need. It will depend very much on you and your lifestyle. One starting point is to think of your exposure. If you don't have a big expensive lifestyle, then it's unlikely that you'll need a big emergency fund. You should have insurance for anything that would be highly expensive to replace. You know, anything in the home that would be expensive, that's what home insurance is for. Anything with your car, you've got car insurance for that. You need to make sure that you've at least got your minimum excess saved though. And it will also be sensible, of course, to have a certain amount of money set aside if you were laid off work, particularly if you're the main breadwinner. You have to make your own judgment call on that though. You generally know how stable your employment situation is. For anything illness related, again, I'd probably prefer to insure against that risk with an income protection policy. But you should always aim to have an amount saved for peace of mind based on your level of financial exposure. Life can sometimes throw annoying things at you, like parking fines and speeding tickets. So have a pot for that. With those basic housekeeping things done, you can start thinking about how to invest. But there's another final consideration to make, and that is how much you're investing in yourself. Investing in asset-backed investments like stocks will produce good results for you long term, especially with the power of compound growth or compound interest. But if you've only got a small amount of money, the best way to multiply that quickly is to invest in skills that can earn you more money. Warren Buffett himself has said that the best investment you can make is an investment in yourself. The more you learn, the more you'll earn. And I love that quote. They don't call him the Oracle of Omaha for no reason. If you only have a small amount of money and you're not already on a direct route to higher earnings, then you'll get the most benefit from investing in learning. Trust me. Just think of something that you're interested in that can make money. It can be anything. It could be property development, it could be stock trading, creating courses, could be YouTube. Just invest in learning about it, do a course, read books about it. Most importantly though, take action. Don't just learn about it, make sure you use what you've learned. Take messy action. You're going to make mistakes initially, but who cares? Start imperfectly. You can't expect to know everything straight away, but the best way to learn is by starting and learning from your errors. The biggest mistake that most people make is just never starting at all. So that's your initial checklist. Make sure you've got rid of bad debt, make sure you've got a sufficient emergency fund, make sure you're investing in yourself. With that done, where do you start? Well, like I said at the beginning, I'm not going to convolute things here. I'm not going to talk about whether real estate is a better investment than building a stock portfolio. That's a totally different subject. What I want to home in on is the main investment wrappers and when they need to start entering your thought process. I won't be discussing in detail the tax treatment of these different things or what you can invest into through them. I'll assume you know that already. But if you don't, I've covered that in previous videos. So check out my UK tax planning playlist. I'll link the relevant videos in the description below, and you can check out the ones that are appropriate to you. Remember also that this isn't advice, it's a template for information purposes. Everyone's situation is different, so if you're unsure about yours, seek advice. Now first of all, we need to have a structure for incorporating these different investment wrappers, aside from just the amount of money you have to invest. For me, there are two key considerations: timescale and objective. Any investment should have a longer term timescale in mind, at least 5 years, but there's one vehicle that's age locked. You can't access your money until you've attained a certain age, and you may already know that's a pension. Now I'm going to assume that you're investing with at least a partial goal to provide income in your later years, so I'll be including pensions in my summary. But if you're investing for any other reason, then they're unlikely to be appropriate. I'm also assuming that these are personal contributions, not contributions through an employer or a company. So if you're just starting out and you've got less than £10,000 to invest and maybe some small regular contributions, there are really only two investment wrappers that are worth considering for tax efficiency purposes, and that's pensions and ISAs. And when I say ISAs, I always mean stocks and shares ISAs. I've given reasons before why I think cash ISAs are a total waste of time, but those two wrappers give the greatest and most simple tax advantages. The ISA makes all of your gains tax-free, and the pension gives you an immediate growth on any investment that you make of 25% through tax relief, with a refund of even more than that if you pay higher or additional rates of tax. The combination of those two wrappers alone will probably fully meet the needs of 95% of the UK population. But how much should you invest into each? Well, I say keep it simple. For maximum flexibility, you could easily just split your contribution 50-50, both lump sum and regular ongoing. What this does is ensure that you've got one pot that's accessible to you sooner, if needed, in the ISA, and another which is out of reach, offering maximum potential for compound growth, particularly if you're starting young. If you're closer to retirement, then allocating slightly more in favour of the pension could be helpful because of that immediate growth boost, particularly if you've got the opportunity to use your personal allowance to take the full amount of that pension investment back tax-free when you stop work. Now, if you know that you're going to want to access the money much earlier than 57, which from 2028 will be the minimum age at which you can access your pension cash, then allocate in favour of the ISA. If you want to know that you're investing for security in your older age, then allocate more in favour of the pension. It's been proven that the pension will usually still produce the best net result for those purposes. It's not guaranteed because it does depend on your circumstances. And I've put some of the mitigating factors up on the screen now. It's not an exhaustive list, by the way. It's just some of the factors that might swing things in favour of the ISA, but you'd need to explore that for yourself. In terms of who to invest with, there are loads of options out there, and each platform has its own advantages. If you're just starting out, cost is key. Vanguard offer a great low-cost solution, and also very worthy of consideration is Free Trade. They have fixed monthly costs and zero trading fees, which makes them very competitive. And you can get a totally free share worth all the way up to £200 by signing up with my link in the description below, so check that out. If you've got a larger sum of money to invest, in the sort of 10 to 100,000 pounds category, to be honest, not much changes. It's only when the investment level exceeds probably £52,000 that you'd need to start thinking about incorporating a general investment account. Now, it may be slightly less than that because you'd need to account for regular contributions that are being made or any employer contributions that are going into your pension. But generally speaking, you're allowed to pay £20,000 per tax year into an ISA and £40,000 per tax year into a pension. Now, I know that adds up to 60 and I said 52, but if you made the maximum contribution into a pension, it would only cost you £32,000. The other 8 would be added for you for free through tax relief. An important point here though, the pension annual allowance is only £40,000 if you earn that much. If you earn less, the maximum that you can pay in with tax relief is the amount that you earn as salary. There are some circumstances where the allowance is much lower, but that only starts coming into play when you earn more than £240,000 a year, or if you've already taken flexible pension benefits. Now, a general investment account isn't really a tax wrapper because your income and gains are subject to tax, but it does allow you to use special allowances like the dividend allowance and the capital gains tax allowance. The best thing to do is check out the video that I've linked above now for more details on that. Don't worry, it's in the same playlist I mentioned earlier and it's in the description below. A general investment account is generally available on any investment platform that you might use, and simply you put the excess in there that you can't immediately feed into an ISA or a pension. All you do is at the beginning of every tax year, which starts on the 6th of April in the UK, is transfer the maximum amount that you can into the ISA and the pension wrappers until all of the money is moved across from the GIA. If you're not using the pension for whatever reason, you just roll the maximum into the ISA every year. Don't forget as well, of course, that if you're married, it's always worth considering splitting the investments with a spouse to potentially double up on those allowances. So the next threshold we look at doesn't really kick in until around £200,000 plus, in my opinion, because before that stage, it's really just a case of following the same process that I've outlined already. Now, this is really just a rule of thumb, but beyond that level, you do have to think much more carefully about the capital gains tax implications of keeping money in the general investment account for too long. The longer it's in there and the more chance it has to grow, the more likely it is that your gains will exceed your capital gains tax allowance and that you'll have to pay tax. It's really when this does become a consideration that incorporating investment bonds into your portfolio becomes advantageous. I'm talking about investment bonds as a wrapper here, not fixed income securities. I did a deep dive into this in my video last week. Now, investment bonds have some great tax planning advantages, and the name of the game, of course, is to save yourself as much tax as possible. The less tax you pay, the more growth you keep and the more that growth compounds over time. There can't really be a specific amount that you allocate because it's all driven by your own tax position. But as long as you have it in mind to start considering this investment wrapper, that's the important thing. Now finally, when we're looking at investments of £500,000 or more, I'd say that there should really definitely be exposure to all 4 of those wrappers then. ISAs, pensions, general investment accounts, and investment bonds, unless there's specific individual reasons not to. Now, the ISA and the pension will probably still form the main thrust of your investment growth and income, fed by the general investment account. But it's at this point that other considerations, like the lifetime allowance charge on pensions and inheritance tax, start really coming to the fore. Investment bonds are specifically useful in planning for those factors, quite often in conjunction with use of trusts. And really, it's at this level that proper advice becomes essential, in my opinion. When you've got this level of capital and more, it's also worth exploring the advantages of specialised tax planning vehicles like venture capital trusts and enterprise investment schemes for their income and capital gains tax benefits, and business relief qualifying portfolios for their inheritance tax benefits. Now, like I said, that really is just a rough template. There could be reasons to explore investment bonds and VCTs and EISs when you have less capital. But if you're looking to do it yourself, that's just an outline that you can use. And as a final mention, it's also worth being aware of lifetime ISAs if you're below 40 and you're either saving for your first house or for retirement. But they can slot into what I've already mentioned, and that's probably for another day.